So you're thinking about investing this year or next year, or maybe even a couple years from now. And in this video, I'll briefly walk you through why you should invest today and why the best time to invest is this year. And the longer you delay investing, the more money it will cost you. And surprisingly, what people think about the cost of investing is actually not the true cost of delaying investing. So before we start, I just want to say that 96.4% of you are not subscribed yet. And it is free, so you can always change your mind in the future. And make sure you stay till the end for the giveaway and the winner announcement. So in terms of Investing Accelerator, Mike has made another 42% from MSI in 3.5 months. So that is the 97th case study in the program. And this month, I'm looking to help 20 professionals without a financial background to master investing and to target 30% a year. The stretch goal is 30, and there will be more details at the end of the video. When people think about the cost of delaying investing, most people think about what they're missing out is really the gains for the first year. You know, at the end of the day, S&P 500 goes up by around 8% a year. So if you invest 100,000 this year versus invest 100,000 next year, well, the difference is only 8%, right? So that's only $8,000. So it seems like it is not a big deal. If you look at the big picture and you really think about investing, what's really the cost of procrastination is the last year. Because next year, when you start investing again, you will still make that 8%, you will still make that 8,000. But as time goes on, the later and later you start, what you're really missing out is the last couple of years of compounding. And that's really where you experience the most growth. So here I've done a calculation that if you're investing with $100,000 from the 9th to the 10th year, and you made 30%, your portfolio will go from $1,060,000 to $1,378,000, so $1.3 million. So the difference is actually $318,000. So when you're comparing, yourself investing today versus yourself investing 5, 10 years from now, what you're missing out is not really the initial years where you started compounding, it's actually the last 5 to 10 years where you wanted to compound and you're really close to retirement, and that's where you get the most gain. If you study the curve of compound interest, then you'll realize that the curve actually edges up higher and higher, kind of similar to COVID. You want to capture that gain really late in the years, and that's actually how Warren Buffett made majority of his fortune. He can actually see his fortune going up like a J-curve. So that's why I wanted to reiterate and create this video, because when you're thinking about delaying investing, it's really about the last couple of years before you compound. And in order to get a high balance when you retire, you need to start early. When it comes to investing, my goal for myself is really to make 30% a year. And when I first started, this seems like a stretch goal to me. I was actually losing money for 8 years in a row, and my confidence was really low, and I don't have a proven and simple investing strategy. It took me 8 years of trial and error to test 300 different strategies to figure out the strategy I'm using today. So after I master investing, my target now is to make around 30% a year. And I have a very simple, proven strategy that incorporates financial analysis, technical analysis, news, so on and so forth. And I'm actually able to condense everything I know into a 4-week coaching program called Investing Accelerator. So if you want to learn about how I invest in the market, then you can grab the 4-hour free training on my website. And this is perfect for you if you're a full-time professional, you have no financial background, and you want to manage your own portfolio with confidence. So the link is 5minuteinvesting.com/free case study, and it is the first link in the description. And after that program, Mike has made 42% from MSI in 3.5 months. So congratulations, Mike. This month, I'm looking to help 20 professionals without a financial background to master investing and target 30% a year. So the stretch goal is 30 people. So in terms of the giveaway, I'll be giving away Sam Walton, Made in America. And it is one of the classic business books about how Walmart becomes so successful. So if we get 100 likes, just tap like below and leave a comment, and I'll select a winner in a couple of months. So from a previous video, I've selected a winner for the book Harmonic Trading 2. So Dave, congratulations for winning this book. If you are watching this video, make sure you go back and send me your details, and then I'll send the book your way. So that is really it for this video. And in the next video, I'm going to talk about how to calculate return on investments for stocks like a real mutual fund. And this is quite interesting because when I was doing research on the videos available on YouTube, not a lot of videos cover how to calculate return on investment correctly. They usually give you a very simplified example, how to calculate a 1-year return or whatnot, but they don't really cover how to calculate your return when you're adding money, because that actually changes your return if you're not doing this correctly. Now, some of the brokers will do it, and I'll show you that as well, so I'll leave that to the next video.